Hey, welcome back. Good morning once again, options traders. Well, I got a request by email from one of the traders in our group here asking about this idea of using vertical spreads to hedge straddles. And it's a really good technique. So, for any of you who trade straddles, you want to make sure that you understand this. Now, I did a previous video that is called Combining Long and Short Straddles. So, you might want to watch that as well. It will help you to understand this video a little bit better, and I'll throw a link in the description below that will link out to that video. But again, for anybody who trades straddles, one of the problems is that if one of those legs goes in the money, well, what do? Now you've got a lot of intrinsic value on either the call or the put side, and people start to get nervous and they want to shut it down. Well, is there a way to stay in the trade but also allow that straddle to be recentered with the current stock price? And the answer is yes, and this is how you do it. Let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's do a quick review of the straddle and vertical spread connections. Remember that a straddle is a strategy where you buy a call and a put with the same strike and expiration. So for instance, you might buy the May 100 call and buy the May 100 put. But now let's take this concept to a different level. Just like we can buy a call or sell a call, we can also combine them. Well, we could do the same thing with straddles. Rather than just buy the straddle, what would happen if we buy, let's say, the 100 straddle and sell the 105 straddle? What's the resulting risk profile? Well, here's one way to figure it out. So we've got our strikes down the center, long and short calls over on the left, long and short puts over on the right. If we buy the 100 straddle, we have one contract of the long calls, one of a long put. And if we sell the 105 straddle, I'm short the 105 call and short the 105 put. But notice that I can view these diagonally as well. I can go this way and say this is a debit spread, and over here on the put side is a credit spread. Right? If you buy the 100 put and sell the 105, you're selling the higher strike put that's got more value. So it's a credit. And the person who buys the put spread would be bearish, the person who sells it would be bullish. So you really have two bull spreads here. And so this is what the resulting risk graph is going to be. This is the straddle at the 100 strike with the calls and puts that we saw. And if we do the short straddle at 105, we get this. And when we combine them, we're going to get this. So if we are long the 100 straddle and short the 105 straddle, we get this. And it looks just like a vertical spread. All right, but notice, however, in the center here, we actually have 200 deltas. And that's because these parts right here between these strikes, we have that twice. I've got 100 deltas long on this red curve, and I have 100 deltas long on the green. But you can see that once we get past this short strike, the red and the green curves here cancel out. Looks just like a letter X right there. So for every long, we have a short. So that's why that black line just ends up going flat. Same thing over here for all stock prices below 100. This red line has positive deltas. The green one has negative. Looks like an X. And so that's just going to flatten out and create that flat part of this expiration graph right here in black. So the point to see is that a straddle can, in a way, be assembled by using vertical spreads. And that's really kind of the secret to using the vertical spreads to hedge straddles. So let's go find out how that's done. So remember, let's say that you buy the 100 straddle for 10. And again, one of the things that makes this very tricky to trade is that, yeah, the advantage is we're playing both sides of the market. We make money whether the stock goes up or down, provided it either does it quickly and aggressively or makes a significant move over time. But the problem is that if one of those legs, the calls or the puts, goes in the money, now traders again get fearful. They go, I just don't want to lose it, so what do? Well, let me go close it. And then they end up missing out on the bulk of the profits. That's a very common complaint about straddles. So take a look at what we could do. Let's say we buy the 100 straddle right here in red. There's our bend at 100. These long deltas are coming from the long call. Over here is coming from the long put, these negative deltas. But notice that we've got this wide area of break-evens right here. The lower break-even in this example is 90, and the upper break-even is 110. And that's just found from the 100 strike plus and minus the $10 cost of the straddle. So 100 minus 10 gives us a 90 break even to the downside. 100 plus 10 gives us a 110 break even to the upside. See, that's the problem with these straddles. It sounds good on paper that we can make money whether the stock rises or falls. Again, that's not really true. It's got to be a fast, aggressive move. And so if it doesn't happen quickly, you're just going to lose from time decay. So for example, let's say that the stock works its way up over here from 100 to 105. Well, that's a pretty good move. We're still not at break even. And then it comes up here to 110. And then it's maybe up here at 115, and we're finally starting to see that we're going above this break even. And then what happens? Murphy's Law kicks in, and then it retraces. And it retraces some more. We're watching time decay kick in, pulls back. Suddenly we're going, hey, maybe the put's going to go in the money. And the stock moves down here, moves down below 85, and then what happens? Moves back up this way. That's just the definition of volatility. A lot of whipsawing back and forth. And that is what can happen if you are trading straddles. And so you just sit here and watch it bleed away. So here's one of the ways that you can hedge this risk. So let's look closer at the straddle and vertical spread connections. Let's start with a straddle, and then let's answer a question: what happens if you sell two vertical spreads? Well, let's go back to our tables here. So here's the long 100 straddle. We're long the 100 call, long the 100 put. If I sell two of the 100 calls and then buy two of the 105 calls, that is a credit spread. And again, it's a credit spread because we are selling the lower strike call. Remember that lower strikes have to be worth more money because they're giving you the right to pay less for the shares. So they will trade for a higher price in the market. So we're selling the lower strike and buying the higher strike in equal quantities. So it's going to be a credit spread. But take a look what happens when we place those two verticals. We get some cancellations here, and we are left with just one short call, and we still have our one long put. And what is that? Well, that is a synthetic short stock position. Okay, so if you're not familiar with your synthetic positions, I do have several videos in this forum talking about synthetics. But a synthetic position just looks, acts, feels, behaves like the real thing, but we're just creating it from different assets. So in this case, we're using a short call and a long put at the same strike. It's going to behave just like short shares of stock. We'll get exactly the same risk graph. So that's why it's called a synthetic short position. But we've also got two long 105 calls over here. So what's going to happen now? So remember what we did. We sold two of these vertical spreads. And what that's going to do, there's our synthetic short stock position. And then when we look at one long call at 105, we would just have a flattened out portion over here. That is a synthetic put in blue. But when we buy that second 105 call, we do this. And look at that in dark blue right there. That is a straddle. It's not in the traditional sense of buying a call and a put, but it's a short stock and long two calls. It's synthetically exactly the same thing. So notice what we've done. We have created a $5 liability between the strikes, but we've received more in cash. And so what that's going to do is it's going to take the old straddle and it's going to shift us up. We used to have a maximum loss of 10. Now we're up here at minus 5. All right, so we've kind of lifted up this gap here by $5. And we've also recentered the straddle. The stock used to be at 100. Now it's centered at 105. So one of the reasons we would do this is that the stock is working up here towards the high side. We're starting to scrape off some gains, but we're still staying in the position. And probably more important is that we are recentering the straddle. We're not letting this call leg start to build up tons and tons of intrinsic value that could be lost. Ideally, you'd like to keep it centered, and that's what we're doing. So there's our center right there, stock sitting right there at 105. All right, let's say that it moves around some more. Remember, these are the positions that we have right now. Stock continues to move higher. What would happen if I did this same trade again? I sold two more vertical spreads. This time I'm going to sell the 105, 110 twice. I'm going to sell the 105 calls twice, and I'm going to buy two of the 110 strikes. So when we do this, these cancel, and we're now left with one short call and two long calls. So So this becomes a back spread on this side, but we could also look at it this way. We've got a synthetic short stock position combined with, there we go again, two long calls. And so that is a synthetic straddle. Now we've moved from the blue to the green and we've recentered. So now if the stock heads south, the put's making money right off the bat, or at least it's building up intrinsic value. So notice that we used to have a maximum loss down here at 10. Now we're up here at 0. We've now collected $10. So we can just continue doing this. And now the next question is, well, what if the stock falls? Well, we're just going to do the transactions in reverse. This is our current set of positions. Stock falls. What happens now? Well, I'm going to short 2 of the 110 calls and buy 2 of the 105s. And so this is going to be a long spread. It's a debit spread. These get canceled. And again, we have our synthetic short position with our long 2 calls. But we've just now recentered at 105. Now, yes, it did cost us some money, but that's part of the idea with volatility. We've sold it at one price and hopefully bought it back at a lower price. And so now we've moved from the green to the black. But notice that the black curve is shifted a little bit higher above 0. So see, this is something that you can do and play this volatility. One of the things that traders like to do is jump on volatile stocks with straddles. Not always the best idea. That's a topic for another video. But when you've got a lot of volatility, you're going to have a lot of implied volatility as well. But the point is that if there is an opportunity to trade a straddle, you need to be able to stay in the trade. One of the worst things you can do as a straddle trader is to buy it for 10 and sell it for 11. That's just taking a whole bunch of risk for no money. Instead, learn how to hedge, roll, and morph positions so you can stay in the trade, continue with your outlook, make lots of money, but at the same time, guarding your downside losses. It's all about being a risk manager, not a profit manager. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.